January 2008. A trader walks into a bank in Paris, and somewhere inside that bank is a position approaching 50 billion euros. The problem? The bank says it does not know the position exists. The trader's name is Jérôme Kerviel. Over the next few days, Société Générale will uncover one of the most extraordinary trading scandals in financial history. A net loss of 4.9 billion euros will be attributed to the positions. But Kerviel did not begin as a famous financier trying to destroy a bank. He began as a relatively ordinary employee trying to make money. And that is what makes the story so unsettling. Jérôme Kerviel was not a billionaire. He was not a Wall Street legend. He came from Brittany and joined Société Générale in 2000, initially working in the bank's middle office, where trades were monitored and processed. That experience gave him something valuable: knowledge of how the bank's control systems worked. He later moved on to the Delta One trading desk. His work involved products linked to major European stock indexes. His trading authority came with limits. According to accounts of the case, his team's global exposure limit was around 125 million euros. That sounds enormous, until you compare it with what came next. According to Société Générale and the findings of the French courts, Kerviel created unauthorized positions and concealed them through fictitious offsetting trades, fraudulent data entries, and forged documentation. On the surface, the fake trades appeared to cancel the real risk. Behind the screen, the exposure remained. And for a while, the concealment worked. In 2007, Kerviel's unauthorized positions made money. A lot of money. Société Générale says the positions generated approximately 1.4 billion euros in concealed profit by the end of that year. Think about the scale. A reported limit of roughly 125 million euros against a concealed gain of about 1.4 billion. The success was not reassuring. It was dangerous. Because when an unauthorized risk produces a huge profit, it creates an incentive to believe the system can be beaten again. But markets do not keep rewarding confidence forever.
At the beginning of 2008, the positions moved against him. Now there was a problem. Closing the trades would make the losses real. Keeping them open left a chance, however small, that the market might reverse. The exposure grew. According to Société Générale, by January 2008, the unauthorized positions approached 50 billion euros. 50 billion. That was no longer simply a bad trade. It was a risk large enough to threaten the bank. Then the control system began to catch up. In January 2008, questions arose over unusual transactions and supposed counterparties. The bank's later internal review described multiple warning signs and control failures. Some alerts had been generated, but the full scale of the concealed positions was not understood in time. During the weekend of January 19th and 20th, Société Générale confronted the situation. The bank concluded that it had to unwind the positions. But there was another problem. You cannot casually sell almost 50 billion euros of market exposure without risking a severe market reaction. Société Générale began closing the positions on Monday, January 21st. The unwind took 3 trading days, and it happened during a period of intense global market volatility. This is where the numbers become difficult to comprehend. Société Générale says closing the positions produced approximately 6.3 billion euros in losses. Against that, the concealed activity had produced roughly 1.4 billion euros in gains during 2007. 6.3 billion in losses, minus 1.4 billion in earlier gains. The net result? 4.9 billion euros lost. On January 24, 2008, Société Générale announced the scandal to the world, and suddenly, everyone knew the name Jérôme Kerviel. But the announcement created a question even larger than the loss. How could one trader do this? How could a single employee build positions approaching 50 billion euros inside one of Europe's largest banks? Société Générale said Kerviel deliberately concealed his positions and exploited weaknesses in the control process. Kerviel never denied masking the positions, but he argued that his supervisors knew he was taking unusually large risks as long as the trades were profitable.
The bank rejected that claim and maintained that he acted alone. Investigations and later court proceedings also examined serious weaknesses in the bank's internal controls and supervision. That is what turned the case into something more complicated than the story of one rogue trader. It became a battle over responsibility. Was Kerviel solely responsible for the unauthorized positions? How much should the bank's systems have detected? Were warning signs ignored? And when profits appeared, did success make people less willing to ask difficult questions? Those arguments followed the case for years. Kerviel was arrested and prosecuted. In 2010, a French court convicted him of breach of trust, fraudulent input of data into a computer system, and forgery and use of forged documents. He received a 5-year prison sentence, with 2 years suspended. In March 2014, France's Court of Cassation confirmed the criminal conviction, but it overturned the earlier civil ruling that had ordered him to repay the entire €4.9 billion loss. The civil question was sent back to another court. In September 2016, the Versailles Court of Appeal ordered Kerviel to pay €1 million in damages, rather than the full loss originally claimed. The criminal conviction remained, but the reduced damages reflected the continuing legal debate over the bank's own responsibility and control failures. The disaster was not created in one single moment. It developed gradually. One unauthorized trade, then another. A concealed position. A fictitious offset. A profit that appeared to validate the risk. A loss that became harder to admit. Another trade. Another attempt to recover. And eventually, tens of billions of euros were sitting behind a wall of concealment. That is how many financial disasters happen. Not through one theatrical decision, but through a chain of smaller decisions that become harder and harder to reverse. The first hidden position makes the second one easier. The first successful deception makes the next deception feel manageable. The first loss creates pressure to recover. And each step raises the cost of telling the truth. Kerviel entered Société Générale as an employee. He became the face of one of the largest trading scandals ever recorded. The number most people remember is €4.9 billion. But perhaps the more disturbing number is 50 billion. That is the approximate exposure the bank says had accumulated before the positions were closed. 50 billion euros. One trader. 3 days to unwind. 4.9 billion euros lost. And one question that still defines the case. How did nobody stop it sooner?